Welcome to the Vaughan Nelson podcast. Today is a fourth quarter 2025 Vaughan Nelson Emerging Market Recap. And with me today is portfolio manager Kevin Ross. Welcome, Kevin.
Thanks so much, Dan. It's great to be here.
All right, Kevin, good to have you. But maybe before we jump into this quarter, why don't we just briefly explain what's going on with the investment philosophy, specifically how the capital allocation framework is shaping the way you build portfolios?
Sure, it's always helpful to start and talk about how we think about investing more broadly. From a high level, we believe markets consistently misprice companies where returns on invested capital are improving, particularly when those improvements are being driven by deliberate, focused capital allocation decisions rather than short-term financial engineering. That belief is what led us to develop the capital allocation framework. And the framework is designed to help us identify companies that are investing in very specific and differentiated ways, often when competitors are either unwilling or unable to do the same. We're not just looking for growth, we're looking for how that growth is being funded, where the capital is being deployed, and whether those investments are likely to drive sustainably higher returns over time, which can be rewarded for shareholders.
Great. Well, thanks for the recap there. All right, so looking at the quarter, right, you had some strong absolute and relative performance. Do you mind walking us through what drove some of that outperformance and maybe in particular how your industry positioning and the areas that you chose not to own contributed to the results?
The fourth quarter was a very strong result, both in absolute terms and relative to our benchmark. What stood out to the team was the outperformance was broad-based across multiple dimensions of the portfolio. First, starting with stock selection was a meaningful contributor. We own companies where the capital allocation story is very clear, the investments are highly focused, and returns are beginning to show up in the fundamentals and being recognized by the market. In several cases, these were businesses investing into structurally growing end markets, while competitors were either pulling back or allocating capital less effectively. That dynamic played out exactly as the way the framework is designed to capture. Second, our industry positioning mattered. The overweights reflected areas where we see disciplined capital deployment, improving industry structure, and rising returns, particularly in sectors like technology, materials, and energy. At the same time, we were underweight or avoided areas where capital intensity is high. And importantly, what we didn't own was also a real contributor this quarter. Avoiding industries with excessive or poorly timed investment helped protect capital and generate alpha for the strategy.
And then thinking about the portfolio itself, any specific industries that contributed quite a bit to performance this quarter? Anything that you found challenging or detracting from at an industry level?
So, our overweights in sectors like semiconductors and semiconductor equipment, materials, as well as energy contributed meaningfully, reflecting our focus on industries where we think capital is being deployed in a disciplined way, and the industry has overall underinvested over a long period of time, and where return potential is improving. On the other side, we had an underallocation to areas like automobiles and components, banks, and consumer durables and apparel, which detracted from the portfolio returns during the quarter.
And then if we're zooming in on some individual holdings, how about walking us through maybe the top contributor that you found and the top detractor that we've had, and particularly what each says about how capital allocation decisions play out over time?
The top contributor this quarter was SK Hynix. This is a case where, after doing the fundamental work, the opportunity was very clear. The company has made very large, very focused investments in advanced memory, particularly high bandwidth memory, at a time when the industry was consolidating and competitors were either constrained by balance sheets or pulling back on investment. Importantly, this wasn't just about spending more capital, it was about investing in the right part of the value chain while others were not. That created a meaningful gap in capability and capacity. And as the AI driven demand has accelerated, these investments have begun to translate into improving returns for the company. On the flip side, our largest detractor during the period was Mercado Libre, which also fits our framework, just at a different point in the investment cycle. During the quarter, elevated reinvestment and short term margin pressure weighed on the stock, particularly as competitive dynamics intensified in parts of e commerce and logistics. What's important, though, is how the company has responded. Rather than pulling back, Mercado Libre leaned into its scale advantages, has continued to invest in logistics, payments, and its broader platform. We've seen similar periods before where the market reacts negatively to this near-term pressure, but over time, we think that the largest and best capitalized platforms emerge stronger as competitors retrench. While it may take time for these investments to fully show up in returns, we believe strongly they are essential to building durable, high-returning businesses in structurally underpenetrated areas like LATAM e-commerce and digital banking that Mercado Libre plays in. Together, these two examples highlight a key principle of our capital allocation framework, which is that the returns don't materialize on a uniform timeline.
Great. And so looking at some portfolio changes for the quarter, there's several. At a high level, what was driving some of those additions, those exits, and then again, tying it back to the capital allocation framework, how do those reflect on your focus on the framework and forward returns?
We made several changes to the portfolio this quarter, as you mentioned. From a high level, these reflect areas where we're seeing the most compelling forward return potential based on capital allocation decisions, rather than a change in our macro views. On the addition side, we found a number of companies making very focused, differentiated investments that we still think are underappreciated by the market. In many cases, these are businesses building platforms or capacity over a multi-year period where the payoff is now starting to come into view. On the exit side, the decision was less about fundamentals deteriorating and more about timing and opportunity costs. In some cases, the investments are simply taking longer to materialize, and in others, the market has already fully recognized the value of the capital allocation investments, and we decided to reallocate to other ideas.
And now I'm looking at some of the new positions in the quarter. They're scattered across different industries, they're scattered across different regions. At a high level, what was some common capital allocation characteristics that you'd identify that made those opportunities look attractive?
You can see the themes clearly when you look at two of the individual additions during the period. The first one I'll mention is Ivanhoe Mines, who is deploying capital in a very deliberate phase way into tier one copper assets at a time when global supply growth is constrained. Rather than overbuilding, they're scaling capacity alongside demand, which we think sets up improving returns as electrification driven demand accelerates over the next several years. The second one I'll mention is Grupo Galicia. The opportunity there is less about asset growth and more about how capital is being reallocated. The company is investing in digital infrastructure and balance sheet efficiency, which should drive operating leverage as the Argentinian macro environment normalizes and improves following the elections that we'll talk about later. That's a shift for them from defensive capital preservation to being in a more return oriented investment phase. Across both of those examples, the common thread I would emphasize is focused investment, improving industry discipline, and a clear path to higher forward returns for shareholders.
And then if we're looking at your top five holdings, right? Same story. They're spanning across different regions and different industries. Any common capital allocation characteristics that give you the highest conviction in those names today?
Our conviction comes from a shared capital allocation discipline across the top five holdings. In each case, these companies are directing capital toward their highest return opportunities while actively limiting investment in lower quality or non core assets. Whether it's investing at the technological frontier, concentrating spend their most productive assets, or reallocating capital towards scalable platforms, the common theme is to increase focus rather than breadth. Another important characteristic is asymmetry versus competitors. These businesses are investing into areas where peers are constrained, be that by balance sheets, technology, regulation, or legacy cost structures, which gives them an opportunity to gain share and earn better incremental returns over time.
And then hopping on around, maybe the last question for today is looking at Argentina, which has undergone a fairly meaningful macro and some substantial policy changes over the past year. How do those developments support some of your recent additions and reinforce your bottom-up investment ideas?
Argentina is a great example of how top down change can reinforce our bottoms up capital allocation views. For the first time in many years, we're seeing a macro backdrop that rewards discipline, reinvestment, and return focused decision making rather than financial survival. At the country level, the shift towards market oriented reforms, fiscal discipline, and normalization of the financial system improves the opportunity set for companies that already had strong assets but were previously operating under distorted incentives. That matters because capital can now flow towards productive investment rather than balance sheet defense. You can see that very clearly with YPF, one of our portfolio positions. The company is narrowing its focus to its highest return shale assets in Vaca Muerta while divesting non-core operations. In a more stable macro environment, these investments carry much higher certainty around cost structures, pricing, and reinvestment returns. The macro shift doesn't create the asset quality, but it allows that quality to translate into improving returns. So, from our perspective, Argentina isn't purely a macro call. It's a case where the improving policy and economic conditions can unlock the value in the bottom up businesses that are already allocating capital well. And that gets us excited for the years ahead for that particular market.
Great. Well, thank you so much for all this, Kevin. And at this point, we will look into returns. So, in the fourth quarter of 2025, the Von Nelson Emerging Market Strategy returned 14.44% gross, 14.14% net, and the MSCI Emerging Market Index has returned or did return 4.73%. Over the past 1 year, or all of 2025, the Von Nelson Emerging Market Strategy returned 46.88% gross, 45.32% net, and the MSCI Emerging Markets Index was at 33.57%. Over the past 3 years, 20.1% for the Von Nelson Emerging Markets Strategy gross, 18.8% net, and 16.4% for the MSCI Emerging Markets Index. Over the past 5 years, the Von Nelson Emerging Market Strategy has returned 11.65% gross, 10.45 net, and 4.2 for the MSCI Emerging Market Index. And finally, over the past 10 years, the Von Nelson Emerging Market Strategy returned 9.97% gross, 8.69% net, and the MSCI Emerging Market Index is at 8.46%. With that, that's a wrap on the fourth quarter. It's a wrap on 2025. So thank you so much, Kevin, and we'll have you back here soon.
Thanks so much, Dan. Talk to you soon.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.